If you haven't seen the cult classic Office Space, you ought to go watch it. Inside that movie, there's a classic line where he says, I have 8 bosses, Bob. Well, here at Nanalyze, myself and the team, we have several thousand bosses, and they've asked us to cover Realty Income. From our perspective, it's one of the top REITs out there. We're going to talk about whether or not it's a good time to buy. That's the ticker. We're going to talk about how they're able to manage risk in tough times and look at some key metrics to watch. So my first experience with Realty Income was probably close to 2 decades ago, and I was initially attracted to what it says on the tin. Realty Income, the monthly dividend company. And I thought to myself, wow, that's rather interesting. You get paid every month. Since then, I realized that's not so relevant when you're budgeting and you're not spending money as fast as you get it. However, that's very relevant to the thesis. We're going to talk about why. This was my own personal introduction to dividend growth investing. It's what spawned our strategy Quantigence that I spent over a decade developing. It's our dividend growth investing strategy. And in that, we're holding 3 REITs. One of those is Realty Income. What's rather interesting about REITs is that the correlation of REITs to equities declines over time. So it actually doesn't become negatively correlated, but it gets quite low. So there have been a number of studies that show that. So from a diversification standpoint, it's a very good idea to hold REITs in your portfolio. Now this bit of metrics here at the bottom, these are rather interesting. Talks about their total return since their 1994 New York Stock Exchange listing and the annual dividend growth rate since then of 4.3%. That's rather low, keeping in pace with inflation, but we're going to talk about why that's not necessarily a bad thing. Don't pay attention really to their consecutive monthly dividends because those could be anything. Pay attention to the increases, and this is the first time I thought about this. They talk about their increases in terms of quarterly increases. Well, here at Nanalyze, we look at champions and annual increases, but that's very relevant for a reason we're going to talk about later. So now when we look at Realty Income being a leader, they're the unquestioned leader in net lease by size. And here you can see they're placed alongside some of their competitors in that space. And when we say net lease, that typically refers to a triple net lease, NNN. That's where the tenant agrees to pay the property expenses such as real estate taxes, building insurance, and maintenance in addition to rent and utilities. So because of that, triple net leases tend to have lower rents, but they're popular because they provide low-risk, steady income. So you're going to see that theme throughout this presentation. Low-risk, steady, predictable. Now, when you think about REITs, there are a lot of different niches to invest in, and we've pointed to 2 here that Realty Income dabbles in. That would be industrial, which is 13% of their portfolio, and retail, which is around 83%, so the vast majority. When it comes to the industries that they're renting properties to, you see grocery, convenience stores, dollar stores, drug stores, and we're going to talk more about those. But what's notable about this firm, at least since we invested a long time ago in the company, is their geographic diversification, which started around 2019, and you can see the investments they've been making. And then when you look at their top clients there, you can see names like B&Q, Sainsbury's, Asda, Tesco. So those are large UK grocers, and the UK makes up the largest geographic diversification at 12.3% in their portfolio. Second place, Texas, and third place, California. Texas at 10%, California 5%, and it goes down from there. But I think their total international exposure is upwards of 13%, so the majority of that right now is in the UK, though they do dabble in Spain and Italy. Now, when you look at key metrics and safety and quality for REITs, it's very important because if you want that track record, that 29-year dividend increasing track record to continue, then you want a firm that's managed by very disciplined individuals. So one of the metrics you can look at, a key performance indicator for REITs, is occupancy rate. Here you can see that average over time at 98% compared to the average of the S&P 500 REIT average at 94%. So they're consistently better over time. And what they're trying to avoid, and they tell you that in their rather verbose investor deck, which contains a lot of gems in terms of nice slides that tell you a lot of good information alongside of things that extraneous information that isn't so useful. So we tried to mine some of the better bits. And this slide here is useful for investors in any REIT. It shows bankruptcies of retailers since 2018, and they talk about how their underwriting process has resulted in minimal exposure to retail bankruptcies, and they're pointing to these various themes that have run into problems. And you see we've highlighted a couple here. Grocery, well, that's odd, right? Because groceries it's the largest component of where they're leasing out properties to. So we're going to look at that in a second. But entertainment here, they say immaterial exposure to entertainment clients outside of the movie theaters. Well, that's funny because in this deck, they actually have a slide dedicated to a bankruptcy. I believe it was Cineworld. They were just pointing out to investors how they were able to minimize the impact of that bankruptcy. So it's good that they're paying attention to this. And when you look at grocery stores, which account for 11.4% of their rentals, you can see here they point out that the top 2 U.S. grocery clients control 32% of U.S. grocery market share. In the U.K., top 2 UK grocery clients control 42% of the U.K. grocery market share. So there's a number of other slides that they provide in their investor deck which look at the largest themes that or industries that they're leasing to, and those are certainly worth a look. Now, one thing we noted is they talk about leveraging advanced analytics to enhance decision-making. And they're using predictive analytics with all that property information spanning 54 years that they can then use to identify, let's say, for a particular chain, which stores might be low risk, medium risk, or high risk, and then act accordingly. So that data is allowing them to operate at an advantage, especially as they scale and get larger with the merger that we're going to talk about next. So when you look at the yield right now at 5.7%, one of the reasons that's quite relevant is when you consider the impact of reinvesting those monies over time on total return. So this chart here on the left, it shows the dip that the company saw in the brief coronavirus market crash there. And then, of course, the recent dip, and that's largely attributed to the merger event that's pending with Spirit Realty. So the company is currently hanging around 52-week lows. You see a lot of conversation on whether or not it's a buy or not. We happened to think that it is for reasons that we're going to discuss today. Now, when you look at the chart here on the right, it shows you total return from 1994 until 2023, so nearly 30 years, and that's with dividends reinvested. So what you would do there is what they call a drip, right? So every dividend that you receive every month buys more shares, a small amount of shares of Realty Income, and over time, that's the impact on total return. So this is clearly an asset that lends itself well to investors who are going to put money in it and then reinvest it into the asset over, decades, right? And that's what we've largely done with our position. And when you look at, they give an example here, the value of 1,000 shares purchased in 2012, the increase in the value of that original investment may be small, 24%, but then consider that 74% of the original investment has been paid back as dividend income. So it's quite powerful when you start thinking about things like yield on cost. So even though you may have had historically a lower yield, I think the present yield is quite high, but historically a lower yield, the yield on your original investment grows over time, right? Because those dividends are growing every month for 104 consecutive quarters. So that has an effect on growing your yield on cost. Now, this merger event with Spirit Realty was not taken very well by the markets. You can see here the press release, Realty Income to acquire Spirit Realty Capital in $9.3 billion transaction, all stock, leverage neutral. It's a complementary real estate portfolio. We're going to look at why, because that's really interesting. And they say here, Realty Income to assume existing debt with low in-place rates. And the stock chart you see there on the upper right, that shows the reaction of the market to this announcement. So the market didn't like this at all. What will happen is that Realty Income will become the 4th largest REIT, up from their 7th place position right now, which is a good thing. We like leaders. That means they should benefit from a lower cost of capital, but also means that the larger size makes it tougher to move the needle when it comes to growth acquisitions. Now, one thing I've noticed about Realty Income and dividend growth investing commentary in general is there's a very large proliferation on YouTube now of these dividend experts. And what you need to do is make sure to differentiate the real subject matter experts from weekend warriors, because a lot of these talking heads are just offering superficial insights at best. They ought to make LinkedIn profiles mandatory so you can see who's talking to you. But one thing that we've noticed is videos where people make stupid faces. Those always contain better content, so make sure you click on those. Now, one individual who actually knows what he's talking about is this gentleman, Robert Berzins is his name. He's from Latvia. CFA, boy, that's a tough thing to accomplish, and I chose a different route. I did a master's instead of a CFA, and I think the CFA probably would have been tougher. These guys spend a lot of time studying for that test after work. It's a really difficult thing to do, and anybody that's accomplished a CFA, generally speaking, knows what they're talking about. He published this piece, Realty Income, Rationalizing the Path Forward. And he mentions a number of things here. The fact that O is becoming so large and is increasingly venturing into more exotic segments of real estate, i.e. casinos and data centers, has caused a logical debate around O's prospects to remain a reliable and relatively risk-averse dividend aristocrat. It's a very good point. He says that O would need to find very sizable opportunities in the real estate space to move the needle. Now that they're getting so big following this acquisition, the chances of finding very opportunistic deals are inherently narrower because typically these large sellers are institutional investors that know what they have. They understand value, so it's difficult to get good deals. And then he mentions something very interesting. He says, as they become larger and more diversified across many real estate segments, right? Remember the picture we showed of all the different types of real estates and, their recent announcement about, I think they're going into a partnership with a data center REIT. There's an emerging risk of a conglomerate discount, and we've covered that, right? Conglomerates trade at a discount. So that was rather interesting. Now, on the pro side, Mr. Berzin says, in my view, O is not treated by investors as a vehicle from which huge alpha performance is expected. Instead, investors, at least in his case and in ours as well, expect stability and steady growth in the monthly dividend, gradual growth in the underlying value. So, as risk-averse investors, we like that prudence and stability and low volatility. This asset has very low volatility over time. They cover that in their investor deck. So, he says, for the fulfillment of these two aforementioned aspects, the stability and steady growth and gradual growth in the underlying value, having a gigantic capitalization level comes in handy. So in other words, being a large company is a good thing. And the main benefit is cheaper cost of capital, especially debt financing. That's very critical in the REIT business. Larger REITs have been shown to outperform. That doesn't mean that the larger it gets, the better it's going to perform. That's just an historical observation. He says here, should interest rates start to go down in 2024, O's share price should benefit more than an average REIT because of portfolio duration. You can see here the duration of their average lease term, 9.7 years. So when he talks about interest rates starting to go down, he put up a tool here, and I haven't seen this. I thought it was interesting. I don't know that I would use it much because I bet this changes very rapidly over time, but it, based on futures, shows the likelihood of the Fed's meetings having a raise or not. So the top table is fairly intuitive. You can see there the basis points along the top, meeting dates down on the left. But the table on the bottom is a simpler look, and it simply says that, okay, we have a meeting coming up in the first month of 2024, and there's a 93% there's not going to be a change. And there's a 2.8% there could be a hike, right? So for all those out there speculating on what interest rates might do, you may want to take a look at this if you're into that sort of thing. I think, as I said, this probably changes very quickly and wouldn't be of a ton of use aside from people who may be trying to speculate more than invest. But it's interesting nonetheless. Now, when you look at dividend growth for Realty Income over time, here you can see the recent schedule, at least from 2015. You see 5%, 6%, 4%, 3%, 3%, 2%, 4%. So it's these, keeping up with inflation, perhaps, as we said, since 1994, a 4.3% compound annual growth rate for these dividend payments. So those concerns about the company growing large and not being able to grow are certainly merited. But what you also need to look at is the payout ratio. Now, for REITs, calculating payout ratio is different than just how you would traditionally do it. It's why we've left that field blank in our own strategy, and we need to spend some more time looking at integrating that data set. But somebody else has done that for us here, and this is Simply Safe Dividends, and I'm assuming their data is correct. I found it to be fascinating. So here you can see that over the past 10 years, the payout ratio for Realty Income has steadily declined over time to a decade low payout ratio of 75%. What does that mean? Well, it means that they have a 25% buffer. So even if they run into problems, they can still have dividend increases and keep that track record because they have that buffer. Now, the beauty of our strategy, Quantigents, we really don't care what's happening over at O, to be honest. We cover this because our several thousand bosses asked us to. Should the company ever stop increasing dividends, they're gone. We're kicking them out of our portfolio. Find somebody else. We're still holding 2 REITs if that happens. As I said, we hold 3 REITs in this strategy. That over 100 consecutive quarterly increases is relevant because that track record is going to break before the annual one does. So that's going to be your red flag there that they're running into problems if they ever break that track record. Very, very impressive that they have those quarterly increases so consistent over time. It's discipline, right? Annual increases at even the smallest increments in our mind, that's acceptable given our yield on cost, but that does raise some questions. So would 1% growth going forward into perpetuity, is that acceptable? I don't know, right? That's something that we need to think about, and I think you'd probably have to consider your yield on cost there. But we're going to check back in a few years from now to see how things are going with the merger and dividend growth. Investors with a horizon measured in decades who can enjoy the monthly compounding effect here might find O offers a very attractive yield at these levels. That is, that yield is now generating cash that you're putting back into investing shares of Realty Income, what they call the snowball effect, right? So one interesting bit of homework here could be to back test that compounding effect at monthly versus quarterly intervals. Because this is a monthly dividend payments company, and there aren't many of those out there, how much does that extra compounding benefit the overall total return? So we didn't have a chance to do that. Could something one of you MBAs out there could do that would be rather interesting to look at. Now, we have some upcoming videos that you might be interested in. So subscribe to this channel. We're going to cover the best dividend ETF. We're going to look at the dangers of high yield. And of course, this recent piece that we've been working on analyzing ARC's trades is rather interesting. So I'm going to put up another video here on finding the best REITs that you might find interesting. Be sure to subscribe and like this video, please. Thanks for taking the time to watch this today.